The bears are circling. All eyes are on the Fed again tomorrow. Will he or won't he raise rates higher and faster than expected? Tomorrow could be the Fed's biggest rate increase in decades. Yesterday's crash officially put the S&P 500 into bear market territory. We kind of saw that coming, but now everyone is starting to worry about recession. Today on Dumb Money, what we're doing, the moves we're making, and a little historic perspective from three dudes who have been through their fair share of bear markets.
We are Dumb Money.
Three friends who turned $30,000 into $30 million using nothing more than Twitter and a zero commission trading account.
The suits that work on Wall Street, they call those people the smart money. That's not us.
Our goal is to help level the playing field for everyday investors.
We are Dumb Money.
Hey there, Dave here along with Chris and Jordan. We are Dumb Money. This is vacation edition of Dumb Money Live. As we normally would, Chris and I always go on vacation together for some reason. Chris has his vacation shades.
Dude.
But not your pink headphones.
I slept in late this morning, and all I did was watch Meet Kevin and Graham Stephan inflation, recession, market crash episodes.
I watched both of them yesterday at 2 times speed just to get caught up on what happened yesterday, which was insane. Not only was the NASDAQ down 10% from its high, or from its already slumping time last Wednesday, so 10% in a week. Every stock in the S&P was in the red at one point. I think 5 companies closed positive for the day. We saw Celsius shut down, lock down, at least temporarily freezing assets, and we'll see if they're going to ever be solvent again. But this is a crazy time.
But here's the thing, man. I honestly did watch a lot of finance YouTube this morning, and I think if we can do one thing in this episode, it's like, let's cut through the BS, because if you want to really get down and dirty in terms of running every theoretical macro scenario that could play out with the Fed, with inflation, with recession, with an earnings recession, with stagflation. I mean, it's kind of mind-numbing. I would watch a lot of Meet Kevin's because he's like going deep and he's literally going over every single scenario that could play out. But at the end of watching all of that, I was like, all right, so now I'm walking away more confused. And
I have a lot of information now. I feel like I'm an expert, but what do I do with it? And that's what I think we need to talk about, because we've been through this.
But Dave, on the flip side, you have someone like Graham. Watch a couple of his episodes, and he's basically saying the same thing. Give him credit. Mm-hmm. He's been saying for years, which is literally do nothing different.
Keep dollar cost averaging. Keep putting money into your 401k. Keep going. Because historically, we have seen that we've never, any 10-year period, the market, I think only 5 times in history would not have recovered in a 10-year period. And every 20-year period, you would have recovered.
You're exactly correct. And that was essentially Graham's most recent episode. So listen, I'm a centrist. No surprise there, right? So I always think that when you go to the extreme of any type of situation in life, you're probably better off being pragmatic and finding something in the middle. And I think, we're not financial advisors. This is not our advice, but this is what kind of we're doing and how I'm thinking about this. Because me and Dave yesterday, we were talking about what the hell do we do?
Literally, we were having this conversation on the beach yesterday. I don't know what to do with my portfolio. I feel like if I make any move, it's going to be the wrong move. So I've just been sitting tight, watching my portfolio value just drop. How about you, Jordan? What have you done?
So 4 days ago, I sold short the XLY and the XLK and the XRT, but I covered that one a little early, but I held my shorts through. Oh, I still got them. And that's helped buffer this a little bit, along with being heavy in cash. But yeah, I still got hit yesterday.
But here's the thing. I think on a higher level, I think the biggest question, and this is, I finally came to this kind of solution for myself, just trying to think about how do I think about this market this summer or on a daily basis. I don't think it's doing the exact same thing we've been doing for the past 10 years. And don't get me wrong, I think if you're going to choose one or the other, that's probably if you're going to have to choose one of the two things to do the same thing or do something dramatically different in this scenario, I think I would just do the same thing. But I'm also not going to do something dramatically different in terms of trying to predict the macro moves of this market on a daily or weekly basis. I think there has to be something in the middle in terms of, okay, we spent the last 5 years levered. Everyone knows that to watch our channel. In some cases, I was 90% levered and then investing in call options. So you could theoretically say I was like 130, 140% levered.
Yeah.
Nuts, right? So at the same time,
So you've delevered everything, and now you have hedges in place.
it's just a different environment.
Shorting the SPY and the QQQ.
But let's talk about what are people thinking about right now, right? Like we're change in real GDP. That's like a big thing that everyone's talking about. Real GDP is most likely to come down, right, dramatically in 2023. That's a major problem for company and earnings, right? Also, the terminal rate of funds, which is kind of driving that, is 100% going up, right? Like we know that the rates are going up, not half a point, but likely 3/4 of a point twice this summer, and then some after that. Layoffs. We know layoffs are happening. We can discuss in this episode to what degree they're happening. Are they going to maintain just in crypto, go beyond crypto?
Yeah, we just saw that unemployment has kind of hit its new low. 95% of the jobs that were lost during the peak of lockdown have been filled again, but we're switching the other way now.
Are we going to get an earnings recession on top of a regular recession, which would mean that we would have essentially, quarters of basically, negative earnings like that, like non-earnings growth. So there's a lot happening now that looks very different from the past 5, 6, 7 years. I think you have to take a different approach, but it's not a daily approach. Like I'm unlevered, I'm hedged, right? Yeah. I think there are more questions than answers this summer. I think nobody knows what's going to happen. I don't care how good you are at analyzing macro trends. There are too many variables. It's not one thing. It's not like if you read articles about what the Fed's going to do the next 2 days, it's not are they going to do this or that. It's like 3 or 4 or 5 different things that we're looking at. They might do 2 of these things, 2 of those things. How is the market going to interpret that? Who the hell knows? Like you can't say with confidence that you understand how this market is going to interpret all these various Fed moves, and then what degree of layoffs is this market expecting? I have no freaking idea. Are they assuming that it's going to do crypto and then a few more outside of crypto? Or is this market already pricing in layoffs across every sector, which, by the way, I think is a possibility.
Yeah.
And I don't
Well, we
think
just
the market...
saw today that Redfin cut like 18% of positions, something like that, like a large amount of positions.
But Jordan,
basically citing a lot lower volume in home sales.
But what are we seeing even in our private, like in the private companies that we're invested in? We're invested between the 3 of us, probably 80 to 90 early stage companies. And we see tons of emails. We see VCs that are recommending do this, do that. I'm seeing potential layoffs that are happening in early stage.
You're seeing layoffs. You're seeing people really try to bring in investment dollars at unfavorable either terms or valuations, right? And so these things are just starting to come across.
But
it happens slower in private, right? Because it's very quantum. How what the valuation and what.
But it's happening. But Jordan, the messaging going to these companies that I've seen is profit matters above all else. So companies that were not intending to be profitable this year or next, all of a sudden are doing whatever it takes to slow down growth and yet to figure out how to become profitable, because that's the only way they think they'll be able to continue to raise money and or survive in a situation where they're not able to raise capital this year, next year at reasonable valuations, and they need to survive on their own. And to be profitable, you need to lay off. So the question is, do we think that message, and I think this message is certainly being carried over to public markets, every public company is right now thinking, we kind of need to, if they're on like Airbnb is on the fringe of like being profitable this year. And I think they'll probably be profitable with their current staffing in place, right? But let's say the things kind of tilt back a little bit. I did get a message from one of our community members saying that their Airbnb was like starting to level off a little bit the last week or two. Like if that happens, don't you think Airbnb is going to be like, do we need to show profitability this year? Even if we have to lay off 5%, 10%, I think so many companies are thinking about that. There's no way that mass scale layoffs are priced into this market. Would you agree? No way.
Well, I don't know. I think it's maybe expected a little bit just as a cost-cutting measure, right? And so I think that's where I'm kind of, I don't know. I think maybe it could be viewed as a positive. As negative it is for people.
Long term,
it is a positive. We've always seen that layoffs help with profitability. Layoffs don't help with the economy, right? So yeah, it's this like weird dichotomy where it's
good and bad, right? So it's bad for those people's budgets and their spending into the economy, but it's good for cost saving measures.
The economy actually, or the Fed needs people to spend less. They need people to have less money so that they can have lower demand for everything.
If you really dig into some of the CPI and where inflation and deflationary numbers sit, is it really CPI is really coming from a few places, and most of it's energy, housing, things like that, and so. Most of the discretionary type spending is already starting to come down. You're seeing discounts. You're seeing inventory raising. We saw that at Target. You're seeing discounts on electronics and things like that. And so, yeah, I mean, where people are, choosing to spend money, that's dropping. But where people have to spend money, it's getting more expensive. And so it's that's also kind of this dichotomy that's going on.
Where are we now in the interest rates for things that are excluding energy? What is our interest rate? Like
the CPI X energy, I don't know. I don't have that on the top of my head. It's still high because of housing, right? And so housing's still expensive.
Yeah. Listen, I don't think it's priced in. I think there are way more questions and answers that will play out over the next few weeks to few months, unless something significant happens that's off radar, that's unanticipated, that provides a lot more visibility. If the Fed does something dramatic, I don't even know what that would be to kind of add more visibility. Because right now, if you look at what the Fed, I'm not going to run through all the scenarios. This would be a really boring episode. Just what you could watch Meet Kevin. He's way better at doing that on his boat on vacation. Like he ran through every scenario, but in every single scenario of what the Fed might do, here's what I took away from it. No matter what they do, whether they announce that real GDP is going to come down realistically all the way down to 0.5%, like no matter what they do, it's going to be a negative for the market, is what it seems like in my head. The market's going to interpret it as a negative. They can be truthful with us and honest, right? Or they can show that they're out of touch. Either way, nothing's going to really make the market feel great.
Here's the problem. So they're already out of touch because, it's not if they raise or don't raise from here and the amount that they raise. I think that doesn't really matter for the, for what you're talking about. The policy mistake that they made was not raising sooner, right? And I'm talking like, a year and a half ago, when things were starting to get red hot, they should have been incrementally bumping up their rates at that point. The mistake that they made was continuing to keep rates near zero while things were totally out of control, and leading us to where we are right now. And so then you're going to make another mistake by raising rates into a slowing economy, which is disastrous. And we've not had that, right? And so most of the time you see that the Fed lowers rates when you see GDPs, and earnings revisions starting to come down. You see the stock market decline 20%. Normally the Fed would be cutting rates, and right now
that's what they did in 2008, 2009. And
sure, and so they're looking at raising even further and faster while we have these things going on, and so it's like a secondary mistake, or just a continuation of the same mistake by being what you could call like pro-cyclical instead of counter-cyclical.
But what matters, Jordan, is I cannot seem to find a single scenario in the short term, and maybe I'll come out later and say I was wrong, I missed something. In the short term, a single scenario that where the market is going to be like, yes. I mean, we could get bear market rallies. I'm not saying
we haven't found the bottom, and I can't see a scenario where any time in the near future is that bottom.
Yeah.
Right?
Well, what could the Fed possibly do in the short term to make this market feel really good and have really good visibility? And what could companies do in the short? Like, I just don't see anything.
So they really don't have any, like, they don't, theoretically, they're not really supposed to care about, asset prices, right? What they're supposed to care about is inflation and jobs, right? And so, or unemployment. And so technically unemployment is still at a low.
Checks the box on
inflation is a high. And so really they need to raise, but these things can flip really quickly, right? To where you get unemployment shooting straight up.
So here's the one scenario that I see the market just flipping and starting to head back up is Jay Powell tomorrow saying, you know what, we're going to slow down the rate that we're raising these rates.
Okay, but if he does that, Dave, first of all, it seems really unlikely.
It's
but
0% chance, I think.
But even if he does that, don't you think that that would lead the market to massive confusion and being like, this is going to really be bad then? Because it's like inflation, right? In that situation, inflation is a massive concern for the market, right? Like, so I just don't see a scenario, even if he does that, I don't see that as being super helpful. So listen, on both sides, here's the way I'm looking at it. In one extreme circumstance where we essentially have money printing, which is what we've had for years now.
And we're still slowly printing money. Yeah. We haven't even hit the flipping point where money is being sucked out of this market.
I'm 70% levered. We all know that. I've been 70% levered for the last few years. In situations that are exact opposite of that, and I think this is the exact opposite, I am nearly 70%. Hedged. So I've been talking about this on the show for the last couple months. I've been 70% hedged for the last couple months. Even at 70% hedge, I am getting destroyed. So I can't even imagine if I wasn't 70% hedged.
Imagine my portfolio, because I have not been consistently hedged. I've been off and on hedged using options, but I think it's time for me to. I just couldn't do it yesterday because the market was in free fall, and I wasn't going to just like short something that seemed to have already taken the hit for the day.
Here's the thing. I think I'm going to remain between 40 and 70% hedge, most likely throughout this summer, unless something happens that is off radar that makes me change my mind, in which case we should have an episode as soon as that happens.
Oh, for sure.
That doesn't mean that I'm not still looking for opportunities, because the thing that excites me most about bear markets and market crashes in particular are that they treat most stocks the same, unfairly, right? So everything is coming down the same, more or less, right? More or less kind of in the same degree. So companies that deserve to get punished because they were ridiculously overvalued for a different world, or companies that are just particularly harmed by this new environment that deserve to get punished or getting punished, and other companies that are perhaps not impacted as much or never really were that overvalued are kind of getting punished too. And those are the ones where you can find some great opportunities. Like we had an episode about my favorite opportunity, Crocs, all right, it's there. Like we're not gonna talk about that again, but I'm gonna continue to look. I don't have fresh money I could add into the market. Okay, we all know I don't have a job.
None of us do.
Okay, so the only thing
Jordan has a lot of cash on the sidelines.
Jordan has cash, but I don't have cash on the sidelines. So the only thing I can do is sell something to buy. It's a trade-off. For me to buy something, I have to sell something else in my portfolio. So like for me, I don't love NFTs here. Okay, I've said that. I don't. So I'm continuing to kind of sell off some of my NFTs to find little bits of cash to put into the things I like in equity. I also am looking at other stocks I have. I'm trying to figure out, I'm going to sell some of my other equities to get equities I think that are getting punished unfairly. So if we have more shows in the next few weeks, we're probably most likely to talk about, the best of this bad scenario. Like where do we think we can maneuver money in this scenario amongst our long positions, however long that is? Because for me, I'm only comfortable being 70% hedged. For someone else who's younger, honestly, I would say like if I were 20, 25, I might be 0% hedged here. Like I wouldn't even be hedged.
Yes, if you
Just-
have the time, I
Yeah.
think that what Graham Stephan says to do makes sense. You just keep buying. You put your paycheck into the market every time. It's lower now than it will be 20 years from now. You're making
Well, you think that's not financial advice?
not financial advice, but historically, over 20 years, you're going to be ahead.
Man, here's the thing. I continue to believe that I don't see anything other than perhaps this. I hate this move that we've had away from globalization to kind of more, what is it, national, what do they call it? National, not nationalization. What's the word I'm looking for here?
I have no idea.
The
But I know what
opposite
you're
of
saying.
global-
The opposite of
Yeah,
being
so-
a global
Yeah, so I
participant.
I hate that, but honestly, I do not see. I don't see anything impeding innovation, continued productivity, technology growth. Like I just see this continuing to fuel global growth for the next 15 years plus. So I feel really good about growth, about the market. I think equities are still the best place to be. If I were younger right now, I would be working 24 hours a day, selling my furniture, doing whatever it took to find cash to put to dollar cost average into high growth, whatever it took. I can't do that right now.
Yeah.
But that's what I'd be doing, just getting more cash in. Even if it goes down another 20-30% from here, which is possible. Yeah.
What do we think about crypto? If you were younger, would you continue to have a large portion of your net worth in crypto, or are you
I would never have a large portion of my net.
large meaning
ever
okay,
in crypto.
What was your peak crypto allocation? Was what, 10%?
Oh, no, more than that. I was up to like 20% at
when
one
you
point.
talk NFTs?
Yeah, 20+%. But here's the thing. For crypto, I do believe, and I've only ever had one thesis when it came to crypto, and that was the too big to fail / FOMO / replacement of some other pretend asset like gold.
Yeah.
Well, like that crypto is better than that, right? And even Saylor kind of came out, and I hate everything that he says about crypto, but even that's kind of his thesis: is it's better than gold. It will someday be at least worth what gold is, which is $500 billion. I kind of agree with that. It's probably going to be Bitcoin, right?
It's just different. It's a different asset class than gold. I hate that people compare it to gold. Gold has nothing to do with cryptocurrency.
I completely disagree.
Cryptocurrency is a huge risk asset that behaves
I
more like.
I completely disagree with you, Jordan. Not the way
But
gold
behaves
is priced.
more like speculative tech than it does gold.
No way. No
Yes,
way.
100%.
Not
Go
in the
look at
long
its correlation to speculative tech, and you will see it has no correlation to gold.
Not
it has
in
all
the
sorts of
long
correlation to
term.
speculative tech.
In the short term, if you can look at crypto, I think the same way people looked at gold when it was growing into what it became. But I think ultimately it becomes some type of alternative non-revenue producing asset that is only valued based on what people are willing to value it on, because everybody for some weird reason thinks that they need to have half of 1% of their net worth. And I mean, when I say people, I mean family offices and institutions and banks and everyone else. For whatever reason, that's the only reason why gold has the value it has today. And I
But
think
they're also out of it just as quickly. They use it as a speculative asset. It has nothing to do. They're not going to
Today, but the end game-
with Bitcoin like you would with gold. That doesn't make any sense.
the-
When gold behaves versus when Bitcoin behaves are two different times. So they're different
today,
assets.
but ultimately, if you look at the end game
No,
for
I'm
something,
talking about any time. I'm talking about any time in the market when the way that gold behaves and the way that Bitcoin behaves are going to be different.
because gold is mature today and has become this thing that I'm talking about, where crypto hasn't become that yet. But ultimately, what I'm saying is the reason why I think Bitcoin, whether I believe in it or not, has a decent chance of being worth $500,000, right? The reason why I think that's a possibility and maybe even a likelihood long term has nothing to do with any sort of real value. It has to do with the new world, the new generation choosing, when they get the inheritance that's worth $300 million, their family inheritance, right? instead of having the 0.5% in gold, which is what so much of that is in right now, they're going to have 0.5% of that in Bitcoin. I think it's a 20-year thing that happens slowly, and so I do want to be back in Bitcoin at some point, but it will never
Now,
be.
you're in Bitcoin when things are in a big speculative bubble, and you're in gold as an inflation hedge, right? They're just different. They're different assets. They shouldn't be compared.
Currently,
They're not.
you're right.
People
The
call
correlation
Bitcoin
between
digital gold, and
the
it was a very bad comparison.
I don't, not in the long. I think at some point gold because Bitcoin is not. It doesn't represent the same thing that gold represents today. Doesn't mean that it won't 20 years from now. I think it's on a roadmap to getting to that same point. And when the average person who's 23, who's a crypto investor for ridiculous reasons, when that person turns 50, Jordan, they're going to be looking at crypto the way a 50-year-old guy today looks at gold, right? They're going to look at it the same exact way in 30 years. They're going to look at it as well, I got to have it for some anti-inflationary asset just in case. It's like, it's so
I agree with
stupid.
you both. Today, I agree with Jordan that the correlation between tech stocks and Bitcoin has been proven. But I do think that in the future, because it is basically only valuable because of its scarcity, Bitcoin will be exactly like gold.
Yes, and I think, so everyone's probably right here. I don't have any crypto. I do have NFTs, obviously, still, but I do want to be in Bitcoin again. Likely I'll be in Ethereum again for the next cycle. I'm not in a super big rush, but yeah. I mean, Dave, and it's not based on its inherent internal, value, because they don't generate revenue, they don't generate profits. There's no way to really value it. It's more based on the stupidness of the world placing a value on something. That's it. And we're running out of time, so that is it for today's Dumb Money. Any last closing remarks while I try to figure out where the theme song is? I would keep an eye out for additional layoffs. That's the one thing that I really believe is still not being factored into this market, and that would cause me. Well, it wouldn't cause me to do anything because I'm properly hedged. Yeah. And I think if you're not sleeping well right now, take a look at your portfolio and maybe adjust it to the point to where you sleep better. Yeah. Dave, I am sleeping just fine, but I'm also losing more money. I think I lost 2 more houses in the past 48 hours. and guys, let's continue to look for stocks where there is a dislocation in pricing, there is an opportunity, or social arbitrage like Crocs. And when we find those, that is when we will do a high conviction trade episode. But in the meantime, we're going to keep talking about what we're doing and what we've done and how. But don't overthink this market. Don't overthink it. No. Don't overthink it, dude. Just it is what it is. Don't do less. I would say do less in this market. Trade less. We've been saying that. And that's why I haven't done anything. And I think I need to do just one thing. A little bit of a hedge. But I do need you to do one thing before you click away from this video, and that's smash the like button. Oh, look at that. We got a whole bunch of likes. Can you show them our view before we leave? Yeah. Let's just take this. This is so great. Can we see? Oh, I don't have enough. I don't have enough cord. This is the green here at Rosemary. If we look right over here, you can see the ocean. There we go. I have enough cord to get to the ocean now. There we are. Too good of a view. All right. That's going to do it for this one. Thank you guys so much for watching. We are Dumb Money. We will see you whenever we decide to do another show. See you then.